Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula.
Thank you so much for having me, Brian. Yes, short-term rentals, STRs, everyone calls them. In tax world, everyone calls them short-term rental loophole. I prefer short-term rental strategy because it is a real estate strategy. And it builds your wealth while saving your taxes. So we'll talk more about that. I'm Ashish. I'm a CEO and founder of Investor Friendly CPA. Our clients are 100% investors who do multiple short-term rentals. We had this one client, I forgot to tell you, started with one property and has the 400 in short-term rentals.
400.
I mean, yeah. And you also have to get into the right time and everything. And he was lucky enough in the right market. So we focus on all the real estate investors. We put a lot of cost segregations that you do. So we know inside out of this. And by anyone, you have a lot of questions for me, but I want to make sure everyone goes away with understanding how to actually implement the short-term rental strategy, and also how to maybe have an LLC and stuff, and how do they factor into the short-term rental. If they understand that, they'll be golden. And maybe some rules to actually meet the strategies.
Let's jump right into it. The short-term rentals, I see a lot of clients, they'll come to me to do a cost segregation study, whether it's a new short-term rental or it's a property that they've had on their tax returns on their fixed asset schedules for a number of years. And the error that I see is a lot of short-term rental owners treat them just like they would a regular rental property, meaning just strictly a passive rental property. So you own one property, it's a long-term rental, and they're treating that asset exactly the same. Could you just speak to why that is the incorrect way to do it?
Yeah. This is the whole reason it's called loophole, is because luckily for investors like ourselves, the government has made this as a non-rental. If you really want to understand this in a simplistic way, is real estate in general has a lot of restriction to fund tax savings. If you were to go and buy long-term rentals, but just from operation, you have a $10,000 loss, most likely you will not be used to use that loss to offset your W-2 income, let's say. But the good thing is, compare that with other business. Let's say you open a food truck and then you go do something and you lost $10,000 because of the first year operation. You can use that $10,000 loss and then offset your W-2 income. Long-term rental does not work like that. There's a lot of something called passive activity loss limitation. And you have to be a real estate professional status, and the people call it REX too. So many rules, one of the highest audited tax strategies. But the good news, what I'm trying to say, is short-term rental is different. Even though it's rental in operation-wise, the definition is, and if the property is rented less than on average 7 days on average, you could have 14 days and 1 day and 8 days and 2 days, and on average is less than 7 days Airbnbs. It qualifies as a short-term rental, STR, and then that is non-rental for in IRS. It's non-rental. It's like in hotels and hospitality business. That's why the loophole is. It does not have to go through this passive activity loss limitation rules like a long-term rental. So if you're buying a short-term rental without understanding this, you're doing everything correctly. You're operating as a rental, you're making money probably because it's a short-term rental, but you're not fully using the tax benefit it can offer, like a food truck, or let's say, a restaurant, or anything you can think of from a business perspective. You could open it and save taxes. If you run it as a long-term rental, there's no tax savings, or it's limited and you have to go through a lot of hoops, is what I'm saying.
Yeah, and I tell clients that just look at it as two buckets. You have your bucket of income, you have your active income or your W-2 income or any other active type of income that you generate, and then you have your passive income. And traditionally, long-term rentals or real estate in general is a passive form of income, and that's where your hands are tied. You're not going to have your passive losses jump over into that active income bucket. They're stuck in their individual buckets. And the nice thing about short-term rentals is you can take that active income, if you're actively managing the properties, and help it or have it help you offset your W-2 income. And that's super powerful because you don't necessarily need to be the real estate professional at that point. And you talked about that briefly.
Yeah.
And I always like to talk about the real estate professional part because a lot of clients get it wrong too.
Yeah.
Is just being a real estate agent that's not the only qualification, or if you're not a real estate agent, that doesn't preclude you from being a real estate professional. You just have to be in the real property business. And I think it's so important to work with the CPA that is well-versed in investment properties when you're looking at some of these strategies. So the next piece, or the part that I wanted to cover selfishly, is bonus depreciation strategy. And it's because as a cost segregation specialist, I have clients that are taking advantage of short life assets on a daily basis. They're using bonus depreciation to help offset their taxable income. And fingers crossed that we'll see bonus depreciation come back at 100% a little bit later this year. That's something that, like I said, I look at the news and read every day to see where that bill is moving.
No, I agree. Bonus depreciation could be a game changer for not just cost segregation industry, but even accounting industry, because a lot of people in real estate use that to save taxes. And you have to understand, no matter which party you're in, you could be a Republican, Democrat, everyone's doing the same thing. So that's why it's favorable. So I know they will pass it. I'm almost 100% sure it's going to go through. Good news for you and me is we're going to have a lot of work, first of all. And second thing is, but we want our audiences and clients to understand this so it makes our life easy, right? That's why we do this. We share this same information to them so they come educated. They can have audit-proof documentation we can talk about, and then they understand the concept. Bonus depreciation is so 100% bonus depreciation for the next 5 years. I had clients who have saved $200,000 a year just by running a cost segregation, not even in very expensive property, like in a modest property. If you could do that for the next 5 years and save $200,000, that's $1 million of tax savings that you could have never had. $1 million. People retire with less than that money. You could have just tax savings from, just doing cost segregation. That's why what you do is so important, Brian. You know this. We want people to talk to you and understand the cost segregation, you do it correctly in a better way so we can report it correctly and they have these $200,000 they could not have. And that's what comes from bonus depreciation. So just to recap, you already know this and your audience probably knows this, but just to recap what bonus depreciation is, good. Normally in accounting concept, in tax concept, what happens is when you buy an asset, you have to depreciate it over the life of the asset, right? And if you buy a printer, you have 5 years to write it off, not just right away. But the government incentivizes for economic destructive. I guess they're trying to help the business owners get more money back into the pocket. And they would try to give you this deduction, which you can write off everything at once. You buy a printer, boom, you can write it off. You buy a car, you can write it off. Things like that. Same way, we can do the same thing with real estate, only if you cost segregate, which is what you do, right? You segregate your real estate. When you buy real estate, you segregate your real estate between furnitures, floors, lighting, and fixtures, and they can write those things up. Is what we're talking about bonus depreciation, and you can write up 100% if everything goes well. So,
and I'd say even with 100%, I do have a lot of clients that'll still come to me and they think that they're writing off 100% of the asset. And I just always have to qualify it. When you're looking at doing a cost segregation study and accelerating depreciation on assets, you're accelerating the short life assets. So I always tell them, let's start on the outside of the property and look at what's outside of the footprint of the building itself, your driveways, your sidewalks, your fencing, some of the landscaping. All of those items are considered 15-year assets. So you'll be able to accelerate 100% of the short life assets or your site improvements because per the maker guides, they're 15-year property. And then when we go inside the property, we're looking at your interior improvements. Now, that doesn't mean we're writing off all of your lighting or all of your interior improvements. We're picking and choosing the pieces that we can pull forward based on IRS guidelines. Think carpeting, removable flooring covers. Think about your appliances. Think about certain equipment connections. There's certain items that we're able to pull forward using different court cases and the audit technique guidelines. And those are all going to be reclassified as 5-year assets. And really, that's what we're pulling forward. The building itself, the structure, and the structural components, such as the primary electric, the primary plumbing, your HVAC, hot water heaters, all of that is still going to remain in either 27 and a half year if it's residential or 39 year if it's commercial. So you're not pulling forward 100% of the asset. You are able to accelerate up to 100% of the short life assets. So we're looking at bonus depreciation and using it. That's really what we're talking about.
Yeah. Can I ask you something, Brian? So when you normally do these cost segregations, a lot of people will ask you this. If I have a commercial property, if I have a mobile home park, if I have a doctor's office, everyone has different, like an average that you could write off, let's say 40% of doctor's office because it has a lot of equipments in there. If you're buying with equipment, as you're in your profession, do you have a very high level number that you tell people that you could get up to this amount? Very rough.
But it ranges. I do have let's say a general guide that I use. What I tell clients when they come to get an estimated benefit is I say, don't use like an online calculator that will automatically populate the estimate without having someone put their eyes on it, because there is so much variance in properties. For example, if you have a hotel, a garden style hotel that has no exterior site improvements, you're not going to have a lot of the 15-year property. But if you have let's say a hotel that has tennis courts, it has a resort style swimming pool, it has roads and fountains, all of a sudden the accelerated depreciation on those 15-year assets, because they exist, will really push the numbers up. When I'm talking to clients without seeing their properties, I'll give them a general range. Maybe on a residential property, so in a single family home, you might be looking at somewhere between, I don't know, let's call it 13 to 25%. And that's such a big range. And it's because without looking at that individual property or the condition that the assets are in, it's really hard to just give you a ballpark estimate of what you're looking at, especially if you're banking on getting that tax savings. The other thing that I would recommend is when you're looking at any estimates that come over, a lot of people will say, okay, you can expect to save $45,000 in taxes this year based on a 40% tax rate. And I just have to tell you that not everybody is at a 40% tax rate. So if your tax rate's 25% or 15%, then that $45,000 number that they just threw out there sounds great, but it doesn't necessarily apply to you. So when I look at rule of thumbs or specific numbers like that, I just say everything's individual. You really have to look at the individual property and the individual's tax rate to see how it really applies, because we just talked about active income versus passive income. And that's another big piece of it, is you need to have that conversation.
But 100% agreed. And it gets even worse when the property is in California and $1 million of their 1.5 million goes to your land.
Yeah. So the land allocation, when you're looking at doing cost segregation studies, is real because land is a non-depreciable asset that you have to back out. And the IRS is looking for a reasonable land allocation. They want to make sure that it's the highest and best use and it's reasonable for the area that you're in. And if you're putting a flat 10% land allocation on all the investment property that you own, you're just doing it wrong, because if you have a property that's located on the beach in San Diego, it's not going to have the same land allocation as a property in rural Georgia. You just have to look at it. But on the other hand, if you look at the land allocations per the county tax assessor's records in places like California, sometimes they'll assign up to 90% or higher to the land allocation. The problem with that is when you bought this property, whether it's a single family home or a $10 million hotel, it already had the building on it. It had all the structural components. It was already zoned. They paid all the permitting fees. So while that land might be worth 90% of the value of it, It's not, because you have to allocate it to the purchase price. So it's going to be a percentage. And what I'd say is take a look at the county tax assessor's records, look at an appraisal, see if they gave you a number for a land allocation, look at market comparables, and also look at the RCN number. So the reconstruction cost new, to see what it comes in at. Because if you can't rebuild that property for whatever it is, you're not going to assign it all to the land. So yeah, areas like California can get tricky. You just have to be very careful with land allocations.
Right.
So the next question I wanted to jump into was material participation and passive loss limits. So this is another area that property owners, real estate investors get in trouble with, because they don't realize that just because they own the property, they think they can take the losses that we provide doing a cost segregation study and have it offset their active income. That's not the case. You have to pass several tests before you can do that. And as a CPA, I'd just like to have you speak to that point. I'd like to thank today's sponsor, CostSeg RX, a cost segregation company. If you're interested in a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
That is most likely the most careful thing you got to put in your strategy. I've been through some audits, and I can defend everything else from tax perspective, but I cannot really defend the material participation if you're not going to have the right documentation or you have not understood the rules. There are 7 tests you have to meet. And this, again, I want everyone to understand this. Same rule applies to your food truck, your restaurant business, your cost seg business. Doesn't really matter. Same rule. It's a business. It's not real estate. If you materially participate in your business, then the losses from that business becomes non-passive. People say active, but it's non-passive. And non-passive loss can offset your other non-passive income, which is W-2, let's say, or other businesses, right? There's 7 tests. Most people go through these 3 tests. The safe harbor, the golden is like 500. If you work 500 hours combined and on your short-term rentals, you're done. Doesn't matter if you have property manager, doesn't matter if you're a full-time employee, you're scheduling your property, cleaning your property, doesn't really matter. 500 hours. But most people don't do that if you're just investing. So people will go and look at 2 other tests. And you have to really understand this. 100 hours and more than anyone else is the one test that people try to follow. For you to meet that test, it's 100 hours or more than anyone else. Meaning if your cleaner works 80 hours, you got to work more than that. If your cleaner works 110 hours, you got to work more than 110. You also have to track your cleaner hours. There are multiple court cases where court said, okay, looks like you work 300 hours. Maybe your cleaner works less than that, but you didn't track it. So how do we know? Please make sure you're tracking your other people's hours too if they're daily involved like that, because court will deny it. And then the easiest one, to be honest, the easiest one is called substantially all participate, meaning there's no one else. You're the only one who's doing everything. So you don't have to drag any hours. Even if you spend 5 hours and you're the only one, you have made the material participation. No hour required. There's no threshold. This last point I made is one of the best kept secret. People don't talk about this. If someone comes to you, Brian, and says, hey, it's already December. I'm going to buy the property. Can I do cost segregation any benefit? Am I going to meet the material participation? What are you going to say is this. Of course, you buy the property, let's say December 15th. You put it in the market. You're going in there. It's already in the market. You're doing all the bookings. You're cleaning everything. You haven't hired any cleaners here. Your wife is cleaning, your kids are, I don't know. You're cleaning it. Not kids, but your wife. And then you spend 10 hours decorating it, putting it in the market. Everything's fine. You have 2 bookings, let's say. You're done. There's no hour threshold. You made that substantially all participation test, meaning you did all the work. There's no threshold. And you can get the benefit. Boom, next year happens, you can hire a full-time property manager because you already did the cost segregation. You already got the benefit for that year. Plan it correctly, document it correctly, meet all those rules, and you'll be fine. I know I said a lot of things, but I do want to end this topic with one caveat there. what IRS will say is, and they have said this, we fought it, we won, but they have said, hey, all the hours you put before you put the asset in service doesn't account, which is absolutely wrong. We fought it, we won it, but they said, hey, listen, you go and buy the property, you do not put it in the market, you do all these renovations, you buy furnitures, you travel to the property to fix the mailbox, but it's not acting, then all those hours is startup hours, which is, there's not even word for that. But they said that, and you took months to fight them. So if you don't want to fight them, even though it's New York, correct, put it on the market right away, and then do all the work.
That's it. It's getting the property placed into service, and what that means is it's ready and available for its intended use. So if it's ready and available to be listed as a short-term rental, then post it for rent, and then it's in service that day.
Yeah.
And then the other thing that you said was absolutely perfect too. It's document everything. And I tell clients that is what we're trying to create is audit ready cost segregation reports. And what does that really mean? It means keep your closing statements, keep your appraisals, keep your purchase contracts, keep all of the documents that, if you're involved in an exam, an audit, they're going to ask for. And they're just asking for that information because the burden of proof is on you as the taxpayer, because the IRS doesn't know how much you bought the property for. They don't know what your closing statement looks like. So they're asking you to prove to them, hey, based on the closing statement here, this is how much I paid for it. Based on the day it went on to whatever listing platform you have, this is the date that the property went into service. So really documenting everything is just so important. And that actually jumped right into my next question was, and you answered it too. It's just how do you keep clients audit ready and compliant? And we just dived into that. So I'll let you take it away.
See, you do your own part. As a cost segregation specialist, you make sure you have those documents, and you use appraisals and county records to come up with your allocation, all those things. For the client, though, you as a professional, you'll have all those information. You have a packet for them. You give it to them. Your client saves that. From tax perspective, to get the loophole and to get the strategy implemented, you got to make sure hours are tracked correctly, as much detail as you can. Think of what access you took after you did something. Receipts saved for that Home Depot trip, the flights, and what you accomplished in your doing travel. As detailed as you can be. You know why? Let me give you an example. And with due respect, this is how IRS thinks. We had a client who bought a furniture, delivered to his primary residence, right? And then packed it up in a truck and took it out to his Airbnb and implemented, and put everything in place in service. The IRS agent said, oh, this furniture did not get delivered to your Airbnb. It's not business. You cannot deduct that. You have to understand from an operational perspective, not everyone's going to directly deliver to Airbnb. You might not be even operational. There might be construction going on. You're also going to go, that is how they think, Brian. So you have to basically spoon feed them documents. Okay, this is how I did everything correctly. If they think, they're going to think wrong. So you got to make sure you write down everything, what you did not do. You placed it in service, your contracts, your Airbnb dates of listed, screenshot it, saved it. We give our clients like guides, checklists, and how to do it. You need to follow that. Once you follow that, you'll have audit. You're going to get audited. Audits are random, but audit true is what we talk about. You have set everything up, just strap it on them, and you'll be fine. The other few things I would tell you, what very big things you need to worry about is, okay, if you work with someone like Brian, they will be, cost segregation will be fine. If you go and do DIY, then you're in trouble. But if you work with Brian, cost segregation is fine. Hours, track it correctly. Expenses and everything you do. Make sure you have receipts and everything. Tie in the hours I'm talking about. As detailed as you can be, is my right? People ask me, okay, how much straight book? I said, as detailed as you can be. You have to, that's those three things. And on top of that, if you can understand how to structure your entities and stuff, that also helps, because that's the audit risk. One more example, maybe your audiences will like this, is one of the audits I was involved in. IRS said, which is wrong, but this is what IRS said. IRS said, hey, you cannot combine all the hours from all the properties as one activity to meet the material participation rule. Not right. You can actually, But they're saying all these properties are separate businesses. How is it possible? You have 10 properties in 10 different states. And they're saying, no, there are 10 different activities and you cannot combine them into one to meet mature participation. But if you can combine them, you can really you can really meet the mature participation and you can do tax planning around that, which I'm not going to say right now. It's too much information. But now what I'm saying is this. If you don't want to fight, even you're right, but if you do not want to fight them, do one simple thing. Get an LLC and put all the properties on there, one LLC. And by default, it becomes a one in economic unit. And they cannot fight back with you. Get one LLC, you can have multiple LLCs owning multiple properties for each property. That's fine. Talk to your attorney. But have one holding LLC holds all the assets as one activity, and then document your intention and your business documents as such, and you'll be fine. But man, you have to it's a loophole, and they're trying to get you from everywhere. You got to really document it well, is what I'm trying to say. And exactly what you're saying as well.
And I know you've got a presentation or a seminar coming up tomorrow, actually, that talks about setting up corporate structures. And I think that's just such a valuable thing, whether you have just standard rental properties, if you own a restaurant, a small hotel, whatever it is, it's making sure that you're structuring that entity correctly. And if you're buying multiple properties, especially as you start to bring in partners, setting everything up in the very beginning is just so critical. So with that said, I'm going to go ahead and wrap up the podcast. I think we really did a good job just covering certainly not everything when it comes to short-term rentals, but the basic 4 questions that I wanted to talk about. If the listeners want to get in touch with you, what is the best way for them to reach you to either get a consultation on your tax services or just to learn more about what you do? Because I know you do put out quite a bit of content when it comes to webinars and things like that.
The easiest way you can get in touch with us is just to go to investorfriendlycpa.com. That's our website. It has everything anything you need right there. But just so you know, I love Brian. Brian, if you're anyone who listens to this, just emails me directly at ashish@friendlycpa.com. Again, Ashish is my first name. You can put this in your notes. Email me directly your questions. I'm not even charging you. Just ask questions. If you want to get a call, I'll answer your questions. We like to give. We don't like to charge every single one. If you want to know more about how to implement this, I started here with Brian. Many of your CPAs or your tax advisors do not know. I'm more than happy to jump and tell you exactly what to do. I'll give you some guides. You can do this on your own as well. Just email me. But follow us on social media. Okay, on our Instagram, Facebook, LinkedIn. You just search Investor Friendly CPA. You'll find us. We give a lot of document, good information, tax planning, about everything else. Just get in touch and we'll be fine.
Perfect. Thank you for being on the podcast today.
Absolutely. Thank you.
If you've enjoyed today's episode, please leave us a 5-star review and click the subscribe button. It only takes 5 seconds and it really helps us grow the show. If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.